Yeah.
And then what happens is when we get older, it's like, oh,
I wish I had it.
or that, or it's too expensive, or our health, because people forget that is a huge determinant of being able to get life insurance in our community. You mentioned those statistics earlier. We have a 8% inheritance rate within the Black community here in East States. Yep. So
So 92 people are starting from scratch.
92%, and that it's something.
Astronomical.
It's something that is in the planning that is off.
Yeah.
Something is not transferring. Something
Life
not
and legacy. That's why we're speaking about
right.
it.
With term, think of term as I'm renting a house.
Okay.
I'm renting lodging. Okay, I have a roof over my head for this designated period that I have this lease, but I don't have any lawful rights, ownership, access to the equity in it.
Blessings to every one of you. We are dealing with life and legacy. This is our second episode as we dive into some things that are important for you, for your life as you look at it, because our God is a generational God, and he looks at life and legacy and what we can do to improve that. Let me invite each and every one of you to our Sunday service so you can be impacted. The information is right here on the screen, and I want you to really plug in and tie in with what we're doing. Follow the ministry on any one of these social media links so that you can have updates and continue to move forward. Please don't forget to subscribe to this channel. I understand you're watching, you're being blessed by watching, but it's not just good enough to watch. You've also got to subscribe so that you can get regular updates and prompts, and therefore you'll be able to be alerted when we're having these really important and constructive conversations. So right here in the studio, I have Andrea Hill, and she is really informing us on the importance of life and legacy. Welcome.
Yes.
Yeah.
Thank
How are you feeling? The sun's shining and God is on the throne.
Yes, God is good. Well, and He's a lot better now that we are in full blown summer. So,
Amen.
yes, so the sun is shining. God is good. I cannot complain.
Amen. We were really, really informed and blessed in the last episode. We know you're a believer. And you're a child of God, and we really thank God for that and for where He's placed you strategically in the marketplace, in an area as important as what we're dealing with. I want to really go into, and we looked at why you inspired to get into the field that you're in, but I want to look further at life insurance. I've got a stat here, and it says that life insurance is only taken up by 44% of the African American community, despite 66% of the community saying that they believe life insurance is important. What has been your experience in terms of people, believers, number one, and also those in the community taking life insurance important?
Well, those stats are very informative, and as a professional in the field, I will say that I do see this, and a thought that I have is lack of education around it. Um, you know, maybe parents or whomever before us didn't necessarily demonstrate it. What we do know is we all expire. None of us get out of here alive. So would it not behoove us to have something in place for whenever that time is? And so, maybe some people are of a mindset of, hey, my parents, they didn't do it for me. They didn't, and I figured it out myself. And I see a lot of that. I hear a lot of that thought process.
I was speaking to somebody who said, well, why are you talking about life insurance? Do you plan to die? And they were saying, as a Christian, we believe in life. I don't want to think about death. I want to think about living and living. And I thought, well, this is interesting. And they sort of said, where's your faith? And I thought that at times we can extinguish reality by using the mechanism of faith. And I believe faith needs to be counterbalanced between the two. So some Christians don't know the importance of, being wise and having life insurance.
Right. Well, God even tells us that, our time here on earth is going to be limited.
Yeah.
But we'll have eternal life in him.
Yeah.
And so I don't know if people are thinking that it's going to be walking the earth, having eternal life with him. But yeah, it's about being a good steward. And doing, we all expire and we all have a need. And what typically happens is it becomes a kick in the can down the road.
Yeah.
And then what happens is when we get older, it's like, oh,
I wish I had it.
Or that, or it's too expensive, or our health. Because people forget that is a huge determinant of being able to get life insurance. And with us, what happens in our community, we talked about it in the last episode, where, are there trolls in the back room saying that, hey, these people are a certain ethnicity? Or
Sure.
No, what happens is now, because we waited, we have health challenges. We have high blood pressure, and not to say that you can't get adequate or be insured because of those things. But now there are some people that now our health is not in good standing. And so now we can't even get insurance.
Or the premiums will be high, I should imagine.
Sometimes it's just, there's no insurability. And there can be such a thing as you're not insurable anymore.
Is that because of health challenges?
It's because of health challenges.
No matter what the age is.
No matter what the age is. There are young people that struggle with insurability.
Really?
Yes.
So what sort of ailments would usually prohibit insurability?
Well, I'm not going to say it is going to create a unique challenge.
Sure.
And sometimes as a professional, it becomes a challenge for me to get somebody insured.
But what about someone, say, with high blood pressure, for example?
High blood pressure, you can be insured with that. Those are mundane things. Okay. There are people that are diabetic. You can get, insurance. But I will tell you, they will differentiate between type 1 and type 2. Are you someone that needs insulin? Because that may be a bit more challenging to get you covered. Or there are people that I've run into that have ailments, for example, HIV, and they may have a family and they still may be tasked with certain things. They still have a need, and it's, a duty and, a challenge for me to be able to get them what it is that they need.
So someone with HIV would be a challenge. But but medicine has evolved, and is helping.
But there are still carriers.
Got it.
That are non-accepting of that.
Okay.
Automatic decline.
Sure.
Will not insure you.
Wow. So your company, New York Life, but you also have your own, don't you? So
I'm partnered alongside New York Life. That is one of the main carriers that I work with. But I serve in a capacity of a broker. So again, not everybody is eligible for, that AAA rated carrier.
Sure.
And I may have to pivot because their requirements or the things that they're accepting of, it doesn't match with the client. So now I'm tasked with pairing them with the right carrier that will write or insure the risk.
But they might not be AAA ratings, so they wouldn't have the $18 billion
It may not be,
reserve
but guess
after
what?
their whole payout.
Guess what?
Wow, that's a rich
But-
insurance company.
But I mean,
It might not take all that.
right. It may not take all that because guess what? Insurance, again, is tried and true. Whether you're a AAA rated institution or a AA rated institution or a single A rated institution, they're all supposed to pay out during that time of need. And depending on what we're doing, what our objectives are, because you may mention some people are of a sense that, what do I need? Oh, I'm not gonna die, but life insurance, the key term is in that phrase, life insurance. And life insurance can be used to not just be a death benefit.
That's awesome. So DIME, the DIME formula. Can you explain a little bit about that? The DIME formula.
Okay, so
it's an acronym, isn't it?
It's an acronym. What is it? Debt.
It's income, mortgage, education.
Okay.
Yeah, income replacement. Yeah.
Okay, so there are several different ways and formulas that people may utilize as a professional. Those are great indicators of how much protection somebody needs. And it's all personal because your protection need is based on you, what it is that you're trying to protect, and whatever legacy it is that you like to leave. There are some people, they don't have children. So, the way they look at legacy may be different. But that is a good basis point. So typically your insurance need should encapsulate all of those things.
That's so your insurance need should encapsulate the DIME. So it should encapsulate any debt you've got left over, such as a mortgage or any other debt, your income, so loss of income.
Yep.
We spoke about Keyman, didn't we?
Right.
In the last episode, your mortgage and also education for your children.
Right. But think DIME for that DIME acronym, obviously, that's going to be more towards the personal side, not necessarily the business side, but the same practice and same principles. Typically when I'm sitting down with the client and we're assessing what their protection need, it is going to be geared towards, do I have young, small children? Because like you said, that debt, if I have a spouse, I want to make sure that I have enough insurance coverage that if I expired untimely, this isn't going to fall back and hit them. And now they're tasked with, taking on that burden because this is my spouse. And now they're inheriting the debt that I left unresolved.
Yeah.
So having enough, whether that's student loan debt, if I have a income, I have young, small children. Well, if my mortgage isn't paid off, I sit down with a lot of clients, and sometimes, if they don't have a plethora of assets already built out, it's, well, what is your biggest asset?
Your house.
Your good health.
Okay.
The ability to earn an income, which is where that I comes into play.
Okay.
So if I have,
that would be a good insurance in terms of terminal illness, or
no. So the income replacement. If I earn $50,000 a year and I have children that are for the next 20 years that I'm having to look after, I need to cover a good bulk of my income while they're, minors, going into adulthood to where they can rear and be able to take care of themselves. So there are certain things, if I left here yesterday and my family had to pick up the pieces today, what would I want them to have in their treasure trove? I want them to have all of the monies that I in life would have been able to dole out.
So the DIME is a calculation of what all this would have costed if anything were to happen. So if your debt, income, mortgage, and education for your children come to $2 million, for argument's sake, if once you've done the calculation, that's how much insurance coverage you need.
Right.
So that's the dime.
Right.
Cover
That's
each post or pillar.
exactly with that particular formula. Whereas somebody may not have all that just yet. And so what about my young people that are just starting out and they're building, but they want to do right and put something in place?
They
Well,
need that level of coverage.
Well, so income replacement is going to become big because typically when you're young and healthy, that's your biggest asset, your ability to earn an income over the life of you. Okay?
Wow.
So even though I don't have all the money that I'll generate in the next 20 years, this is what I'm trying to protect because this is what is at risk. So even if not the dime calculation, my income earning ability, if I'm
Which is really important, because basically, if you calculate on a projection and obviously an upscale of what a person would earn over their lifetime, if they was to meet a sudden demise, God forbid, you would want that covered because they are an asset of and by themselves.
They are their biggest asset a
Yeah.
lot of times, depending on who you're talking to and where they are in their journey. And I tell people all the time,
Yeah.
where you are right now is not what it'll look like in 5 years, 10 years, 20 years. So we constantly adjust these goals. And so, but yes, right now, your ability to earn an income for somebody that's young, they want to protect that because that is typically their economic value. And, for us, especially people of color, trying to get them to open their mind to understand that you want to be more insured towards your economic value because the smaller plans that we put in place that historically we were putting in place, like our 25,000, our 10,000, our 30, these are final expense plans.
Yeah.
These are for
That's small
homegoing.
figures. Yeah.
These wouldn't cover.
Aired.
Most of the time, 20 or 30,000, that wouldn't even cover someone's annual income.
Yeah.
So you're doing your family a disservice. You're doing yourself a disservice by not calculating your full economic value.
Wow, that is incredible. So there's some people who may be underinsured if they haven't looked at the dime method, or maybe over, which I suspect most may not be over, but potentially.
Right.
But the dime methods, I don't think you could. Do you think you can ever really be overinsured? Obviously, unless the premiums are too high for your.
Right. I don't think that you can have too much insurance. It's got to make sense. We got to have a game plan. There are people that I work with, like we may have a portfolio of insurance because I will say this too, in our community, you mentioned those statistics earlier. We have a 8% inheritance rate within the Black community here at States. Yep. So
so 92 people are starting from scratch.
92%, and that it's something.
It's astronomical.
It's something that is in the planning that is off.
Yeah.
Something is not transferring.
Life and legacy. That's why we're speaking about
right.
it.
That's
because we need to improve. If so, 92% are just not inheriting or.
Yeah, and it could be a number of different factors. It could be some term coverage that's expired and it wasn't effective or active when somebody expired. They never got something permanent. It could be a matter of we never put a will or trust in place.
That's what I wanted to touch on because I was speaking to someone the other day, and I was actually speaking about my insurance and. My insurance is just going to probate if anything were to happen.
Okay.
And I found out and I said, oh, wow, that's not really what you want. So even though you've got life insurance, you've got to point it toward you. You've got to put it under your will, don't you? Or a trust.
Well,
or else, if it's usually left standard, it goes straight to probate, doesn't it?
Right. So a couple of things. A big benefit and beauty about life insurance is that this is something that can pass probate because you have named beneficiaries that these funds are going to.
Okay.
So you have a named beneficiary, and the only time that something like that would happen is if that named beneficiary you had, maybe they expired and you didn't have a secondary beneficiary or a tertiary beneficiary. But otherwise, that is one of the biggest things about life insurance is that I can have a named beneficiary, and this is gonna circumvent probate. Okay, the payout is gonna be immediate. So that is a little bit different. But there are things that if you want to self-insure yourself, you say, hey, I don't want life insurance. I don't need it. I will be able to take care of that when that comes. Okay. Well, if you have assets, if you have, things that you want to be disseminated, well, so that it doesn't go to probate, you do need a will. And aside from just a will, because a will alone is not, and I'm not an attorney, and so it does take people consulting with an estate planning attorney to get the specifics that are geared to their specific situation. But typically, a will is not even enough. You need
Because there's various types of will, isn't
Right,
it? A
right.
trust is so important.
A trust is the asset, the vehicle that holds the assets.
And all your decisions are already made prior to any
Yeah,
potential.
because the trust, when you sit down with an attorney, they are going to outline based on the directives that you have set forth. So with a trust, you can be as granular, you can be as specified. You could say, hey,
Rip it out over years.
exactly.
You can have your spouse have the benefits of any assets, and then it later falls to the children or grandchildren. There's an array of different
Right.
methods. Yeah, trusts are brilliant.
Yeah, it takes planning. And so already, in line with the conversation that we're having, but that's that additional step of planning. And it's funny, but even estate planning, it is daunting. It's a lot of moving parts. And, some people, they don't until later in life,
Think
they don't,
about it.
yeah, that it's an important thing, but there are a lot of moving pieces.
There are.
So,
And so you would advise a good estate planner, a good estate lawyer
yeah,
to put
estate,
these
yep.
things in place and have it very specific to how you want it to be.
Right.
And also, it costs,
Yes.
but when you think about it, $5,000-$6,000 to have a good trust put together
Right.
is well worth it. I
Right.
know some people look at it and go, "Oh no, that's too much." But when you look at the cost of
Listen,
your assets, in
be
comparison,
it's better to be proactive on the front end than reactive on the back end, because what happens is if you don't want to pay that $5,000-$6,000, guess what?
you're going to pay
To-
much bigger
for
at the back.
probate,
And
to
all
go
the
through
and all the struggles and sibling
you're gonna have
conflicts.
to
It's
get
horrible.
a retainer for $10,000. So it's gonna cost you more on the back end when you are reacting versus to where, hey, if we could have took the time on the front end, you got more options.
Yeah, that's absolutely correct on that. And also, none of us are estate planners or legally trained on that, but
Right.
you can also transfer assets into a trust
Yes.
that are in different vehicles right now. So that's always a possibility. Obviously, there's a process and it costs, and there's a level of assets you need to have before doing it for it to make sense.
Right.
We'll cover that on another episode.
Right.
With someone who's legally trained on that, even though we have info.
Right. Right.
Now, can you tell me the different types of insurance? So, what would you advise? So, because we have different types, don't you? So, if I sat down in your office or over the phone, whichever way, what would you do? What insurance would you advise me to have? And going from the basic to the optimum.
Okay. Well, depending on who I'm talking to, it is going to be tailored to their unique situation. What is the age of somebody? What is the health? Where are they? Do they have dependents? Are other people, are they tasked with taking care of other people, whether they're children or an aging parent? So all these things are going to come into place for me to uniquely line this out for you. A lot of times, we will layer solutions together. Depending on where someone is, we may layer solutions together. And it just means that going back to that, the thought of having a portfolio of insurance, you can have as much insurance as makes sense. We just need we need to have a rhyme and a reason for it. So it could be a layered approach. It could be some term coverage as well as some permanent coverage based on what it is that you are managing. If I'm paying off a mortgage and I know that that mortgage is going to be, obsolete in 20 years, 30 years, well, I'm going to design something where at the end of that 20 years, that end of that 30 years, there's a piece that we no longer need. Okay. But there is always some permanent need within that. Okay. Homegoing. There's always a permanent need if you want generational wealth for children. Hey, it's better to look at it now while you're your youngest and healthiest self and lock that in now as opposed to later, because it will cost you more to do the same things that you want to do more. And then you're at a point to where it's like, you know what, it costs too much. Well, because you've waited so long. So now it doesn't make as much sense. But depending on where somebody is, we may layer solutions, okay? We may to fit your coverage need, because $2 million of permanent coverage may be a lot. It may be hefty for someone. Whereas
on the monthly premiums.
On a monthly premium basis. Whereas we could meet your protection need by combining solutions that fit cost effectively into a budget. But where you are right now, so depending on where someone is, I may build them a solution that is going to layer different plans together, a combination of some term as well as some permanent. That still allows them the ability that, when their financial picture looks different in 5 or 10 years out, they still have the ability to scale up and scale out. So sitting with someone like yourself, I'm going to look at age, I'm going to look at income, and I'm going to look at whatever, your financial budget looks like as well. But I'm going to layer. I'm probably going to layer, but we all have a permanent need. So I'm definitely going to, educate you on the benefits of this and why it probably would behoove you to do it now as opposed to waiting 10 years or 20 years, because I'm just 10 years or 20 years older now.
Okay. So there's term insurance, there's universal, and there's whole life. Can you break down the different ones?
Sure. So there are different types, even just outside of those. But the main three that you'll hear about are, the ones that you just made mention of. Okay. So this is the best example, like with term and permanent whole life. With term, think of term as I'm renting a house.
Okay.
I'm renting lodgings.
Sure.
Okay. I have a roof over my head for this designated period that I have this lease, but I don't have any lawful rights, ownership, access to the equity in this home. I simply have a roof over my head. I'm paying $1,600 for that every month, and for a designated period of time that I have this lease. And at the end of that leasing period, okay, do I recoup anything? So a couple of things with that. So with term insurance, again, it's like leasing a home. Okay.
It's covering me for a set period of time.
For a set period of time, I have a roof over my head. Okay. With term coverage, like any insurance, it provides a death benefit as long as we continue to pay that premium. With term insurance, it's static. It is if I get $1 million 30-year term policy at 21 years of age, that $1 million term policy will not grow in that 30-year time period. But over the course of that 30 years, if something were to happen to me between 21 and 51, it would pay out my loved ones that $1 million of term coverage that I was paying $20 for on a monthly basis. Okay.
So that's interesting. And I'm sorry to interject, but hold your thought, because the 20-year-old that gets a $1 million term insurance. So he's 51 and it expires. He's no longer covered. But let's just say something tragically happened. 30 years down the road, inflation probably means that $1 million is worth maybe 700,000 in today's money. Is purchasing power.
Right.
So maybe you want to insure more than the million or the equivalent of what's a million today. So you probably want to do about 1.4, 1.5.
Right. And typically, even when I sit down, I have a economic value calculator that I look at, and we even say, hey, if you're in the workforce from here until the next 15 years, if we account for 3% raises, this is how much protection we probably need. This is where we want to be ideally landing based off of what it is that you're bringing in. So going back to that, so yes, so term is cost effective. If I'm 21 and I lock into something for 30 years, I'm going to pay pennies on the dollar to have that $1 million of term coverage. And I'm going to have a level premium for 30 years. But at 51, what'll happen is now I've outlived this contract. I didn't expire. I didn't plan to expire
And
either.
a new one's going to cost way more.
Now I'm 51. And so now I'm going back through underwriting as a 51-year-old. And now, so going back to that mortality table, 51 to age 100 on the mortality table, that's 49 years. Whereas if I had locked in at 21 to something permanent, well, 21 to age 100, that's a lot longer. That's a lot further away. So all you're doing is kicking that bucket, that can down the road. Because if you stay in that for 30 years, now at 51, I have to go back through underwriting. Or if that plan hasn't termed out, the insurance company will let it keep going. Every year, it'll keep increasing little by little, until maybe it's astronomical. And they may let it go until age 80.
So on a term insurance, they'll keep taking out the premiums. They'll upscale the amount I'm paying because I'm now over the 30 years. Will they still pay out
if something happened? Yes, as long as I'm paying that premium. Now, with term coverage, all term plans expire by the time someone is 90. Right? So
that's the maximum.
That is the max. Okay? It's not meant to be a permanent item, but all right.
You're leasing.
You're leasing. We'll let you lease until age 90. Okay. Now I'm going to tell you this.
And then if you're still living, bye-bye.
That's for you.
Now the risk is too high.
Now, hopefully you self-insured yourself because
through assets.
You stayed, you played the long game when we all expire. And so now this is termed out. And most insurance companies won't even take an application from someone past 85, and 85 is still, that's a bit up there.
Yeah. So talk to me about Universal. So term is leasing. What's Universal?
So term is leasing. Okay. We don't recoup anything after that. At the end of that 30-year period, if I didn't kick the bucket, okay.
It's like leasing a car. Thank you very much.
Right.
Give back the keys.
Right.
3 years later, bye-bye.
Right. But I will say a beauty about some insurance carriers with term plans, they allow you to get in the door with term plans, but you can upgrade them to permanent plans. And the beauty about that is typically it's limited underwriting, if anything. So if something has happened with your health, again, insurance is all about that. So if I have a portfolio of different coverages and say I have some term in my back pocket, well, I can activate that and now I can have something that's permanent despite my health change.
And it won't cost me that much.
It's just going to cost like whatever age that I am. Like, so for example, the company that I'm with, they give you a 10-year window to where if you lock in with some term, you could, for a 10-year period of time, you could, upgrade that term to something permanent without doing any additional underwriting. So what happens is
you pay the cost, but no underwriting.
Your health, right. You keep your same health rating, but your age. So that if that shifted by 5 years, 6 years, well, that new age, depending on how much coverage it is that you are, breaking off that you want.
The premiums really upset.
Okay.
So universal.
So universal life is, and then lastly, we'll do permanent whole life. Universal life is pretty much a combination of a term type of coverage and a permanent cash value. type of coverage. Okay, it typically has a flexible premium. So, a couple of big nuances. Now, the cost of universal life coverage is typically you get more death benefit with your premium dollars than a permanent whole life. Okay. So, you typically can get more death benefit.
On a universal.
Yes, with a more cost effective price point. Okay. So, it's a little bit more flexible, but how universal life works is, if I had to liken it to something, it's like, say we have a bucket, and every month in that bucket, now with this bucket, uh, the things in this bucket can last as long as we need it to, but we have to make sure that the ingredients that we're pouring into the bucket is gonna allow the bucket to go for as long, and that bucket isn't gonna run dry. So the best ways to explain it: with universal life, you purchase a death benefit. Okay, every month you're paying a premium. Now with universal life, it's flexible. They say, hey, you can pay the less premium, or you can fund it with a little bit more higher cash value. So every month you are paying a premium.
And a cash value.
So every month you're paying a premium that goes into this policy, and then you are getting you're getting a credit. You're being credited. You're getting credits. Universal Life has an interest rate that it gets credited on a monthly basis. Okay, so if you're putting in a premium and they're giving you interest
5%.
or 3.5%, okay,
It's more
because
realistic. Okay.
that's more realistic. Okay, now mind you, over the life of these plans, that interest rate that they're crediting that policy, it could go down. So they may start at 3.5, but if interest rates fall over the life of that plan, what is going to happen? Because again, you have a premium going in there, you have interest being credited in there on a monthly basis, but with universal life you have expenses that come out on a monthly basis. You have mortality expenses that come out on a monthly basis with universal life. Okay, you have costs of insurance fees that come out of universal life. And so although it could be one of the more flexible cash value life insurance plans. The way that cash value works is a little bit different than a whole life, because over the life of you, what happens is that the hole in that bucket could become larger. Why? Because the cost to insure us rose as we get closer on that mortality table to age 100. So the fees that you pay as a young person, a 20-year-old, 21-year-old, they're going to be pennies on the dollar. Whereas later on in life, if I have not increased what I'm doing as far as a premium payment, say interest rates have fallen, okay? So that means that this policy really has to grow by the premiums that I'm putting into here. And again,
So I have to increase the premiums.
you typically need to increase what you are giving later on in life if you fund it on the minimum side when you're young. Okay. So again, you could get these policies to last as long as you need them to, but you have to fund them with enough cash value, because again, right now the premium is low, but what'll happen is the fees on the back end over the life of this policy will start to eat that cash value.
And the interest rate is determined by the Fed, so it goes with the Fed's interest rate.
Right.
Okay.
And again, that can vary. Actually, it's not the Fed's interest rate. It's a different it is based off it is based off of that.
But they create their own.
Right. And it can change. It can change. So again, what it starts at 3.5, they may say, hey, it can't go below 2%. Okay, in the fine lines of that contract.
And how much percent are these fees taking? Because they could be taking all my, if I'm not careful, all my interest.
And it can. And so again, with those types of plans, if they are not funded properly, depending on how long you want to keep this, well, if you want to keep this for a lifetime, it's going to make sense to funded with more cash value in the early years, so it has more in the bucket. So going into the latter years when those fees start to rake up, well, I have enough cash value in that bucket to where to where it's gonna last me a long time. I'm gonna have more longevity.
And I can't loan against this universal, and I don't get payouts
You
loaned away.
so with Universal Life, it's a cash value life insurance plan.
Okay.
So you can borrow from it. You can borrow from Universal Life. You can. But when you borrow from it, it works a little bit differently because again, you have interest that gets credited to this policy. And so if interest rates fall or anything, those things can impact the policy's cash value. So if borrowing, you can borrow from it to answer your question.
You can borrow, and it's paid back through death.
So it's paid back through death, or you could pay it back over the life of you.
Okay. Wow.
You could pay it back over the life of you.
Wow. Okay. And so just to be correct, so Universal lasts for how long? The whole of life, or is there an expiry date on the insurance?
So depending on how that plan is created, it could have a benefit all the way until 121. It could endow at 121. You just have to fund the policy in a way that is for the long haul, for longevity. Because again, right now, when you're young, you have some leniency. So some people may they may get into a pattern to where they're paying less, okay? And they may get into a pattern to where they're paying the lease for years.
And then it catches up.
And then it catches up on the back end because now you've underfunded this policy for so long. Now you have to infuse this thing with cash value so that this policy can stay in force because you need cash value in this plan.
And talk to me about whole life.
Okay. So whole life.
I think we need another episode, but let's go.
So whole life works a lot differently. When we talk about life insurance, that's whole life. When we talk about life insurance, an insurance plan to life, okay? People kind of mix it,
Say that again. Sorry, I'm
whole life is an insurance plan to life.
Okay.
Pretty much.
Sure.
So when we talk about life insurance, well, whole life is insurance that you have throughout your whole life.
Sure.
Not just a death benefit. I get living benefits from this. So just like any other insurance, I pay my premium. The insurance company is going to pay it out, okay? So with permanent insurance, with whole life insurance, it is dynamic. So whatever death benefit that you lock into, it won't stay at that. It typically can grow over the life of you without you having to increase your premium.
How is it growing? Through the interest rate?
No. So, for example, with the company that I work with, whole life is built on certain guarantees. And so the guarantees are, we're going to lock in your insurability. We're going to freeze you at the cost that you lock in.
Yep.
Okay. And that's the premium cost that you'll always pay. How does it grow in value? It's not through interest, but the guarantees of whole life is the cash value and the death benefit are supposed to equal the same amount by age 100.
Okay.
So, for example, if I buy $100,000 death benefit, okay, over the
and cash value. Let's stick with death benefit.
Cash value is something that grows over time, okay? So it's the equity that starts to grow from having this asset over time, okay? It takes some time to grow it out. Depending on what you do with whole life, you could do a traditional route or you could do a custom whole life.
So whole life is an asset.
Whole life is an asset. Whole life is an asset, okay? So when we think about...
So the cash benefit is being generated from the asset, which is I'm insured for life, and therefore that asset is creating a cash value.
Right. The premium that I'm paying, it's going to create a savings reserve if I continue to pay into this 10 years, 20 years. And with some companies, you can get some additional growth in that cash value if you're, partnered alongside a AAA rated company that, for example, the company that I work with, they are a mutual company. As a mutual company, they are privately held, okay? So they're not publicly held companies. They're not privately held. So they're not beholden to shareholders, the stock market, the things that are impacting us right now. And so with that being said, as a mutual company, policyholders, when we have a surplus or, excess, we pay out dividends. Those dividends have the ability to grow your policy's death benefit. It have the ability to grow the equity in your policy. So not only do you get the guarantee that, okay, this cash value is going to grow year over year because it is going to equal up. If I got $100,000 death benefit, by the time I'm age 100, the death benefit and my cash value are going to equal the same. But my cash value can grow in addition with that. If I overfund my policy, my cash value could grow larger than that. Or if I receive dividends from this AAA rated company that has a track record of paying them out, that can grow my cash value. So that can allow me to do even more. But yes, so that's the guarantee. So I'm guaranteed I freeze my age, okay, my cost of insurance. So if I lock in at 30, that is the rate, the premium that I pay forever. Okay.
So if you do it at 30 and you're paying $100 a month, for example, that's the $100.
That's what you lock into
for life.
Yes, correct. That same premium that you're paying at 30, you'd be paying it at 60.
And if I start paying in 2 or 3 or 400, it spills over to my cash value.
Yep. It'll go directly into the policy.
And increases my dividends payout.
Well,
from a AAA rated company that's got the mechanisms that yours does.
Yes, and what I notice a lot with clients that I've inherited that have been with the company for as long as I've been alive, they are receiving dividends to the tune to where now they could use the dividends to pay the premium. They can use the dividends to pay the premium. And now they got to have a fully paid off asset that's still growing in value that they could still borrow from.
I didn't know whole life insurance was an asset.
It's an asset. If you ever heard have you ever heard of the phrase be your own bank?
Wow.
Infinite banking. Well, the principle behind that is having an asset such as a cash value life insurance asset that will grow over the life of me, and I can tap into its equity and I can utilize it for anything. I could be my own bank of sorts. And if, yes, you have to pay yourself back, but you don't. If anything, it will get deducted from the death benefit. People utilize these things for different things. Maybe it's to pay off a mortgage. Maybe it's to supplement their retirement, and they can use the tax-free monies in here. They could borrow from themselves to do that. So sometimes it's about creating a line of equity. When I help somebody determine what their economic value is, it's about helping them to create a line of equity that if they did want to turn it on to where they could be their own bank of sorts, hey, I can create this asset based off of my good health.
Wow.
And not everybody can have it because your insurability
is important. So it's the age you do it. Be your own bank. What a powerful insight by Andrea Hill. How do people get in contact with you?
Well, I am online, so they can reach me by mobile. They can reach me at my email address. That's aghill@ft.newyorklife.com. So you can email me and we can set aside some time and we can meet via Calendly, via Zoom, meet in person. I can be contacted via mobile. So my email address, and I'm sure that you'll make sure that your congregation will get access to it.
Yeah. And the information will be placed on the screen. This has been so insightful and impactful. I'm trying to convince Andrea to stay for one more episode. You'll see if that is possible, because this has been so great. Join us at 10:30 a.m. every Sunday, CLCC, you'll be impacted and blessed. Pastor Mitchell will deliver a word, and your life will be changed. And also, the worship is exceptional. Life and legacy. We'll see you next week. God bless you. Wow.
We may do.